So I think I get the kind of gist of what's going on, especially with me. I feel like I have such a small bank account that, like you said, it's going to be verticals I'm going to be selling.
Mm-hmm.
So from my understanding, it was basically I'm selling a put. Say Facebook is selling at 160, I sell a put at 150, and then I buy a put at 145. Somewhere to create that $5 spread, or even if it went lower, buying something lower. I guess that would make me more money in a sense.
All right. Well, okay. So right now, considering that Facebook was trading at below 150 just this past week, it never closed below 150. I think one day this week it was around 152, but intra-week, or intraday, it was definitely below 150. I think it was around in the high 148s. So do you think it's smart to sell a 150 strike right now? I know that it was up around $5 or $6 on Thursday, but you think that's a high profitability, high probability trade?
Well, I mean, if you think it's going to go up, but if I was going to play cautious, I guess I would set my bar a lot lower. If we're talking about what I guess current prices are. I was trying to use just like a for instance, saying this costs this.
Right.
I'm trying to get it like a rule of thumb. Because almost in any kind of business or anything you do, there's always like certain things you will look for and you will go to. Like I said, I know I do electrical work. Somebody tells me something's not working. First thing I do is I go to your electrical panel. That's the first check. There's always going to be a checklist, and then you basically using your experience to figure something out.
Okay.
After that.
So yeah, I understand what you're saying. So, but yeah, you do understand like the general gist of it. But I'm going to ask you a few questions because I want to make sure that you have a firm understanding of it. What are the dangers of selling verticals?
The danger of selling a vertical. I guess you're limiting yourself in a sense. I mean, that's kind of what I was going to say. The buying power was what I kind of noticed about it. I'm not 100% probably.
The problem with selling verticals and using verticals as opposed to naked puts, and actually I had this conversation yesterday with a student after I warned him about it, and he got in trouble in his practice account because this past week or the past 2 weeks have been very volatile. Human beings are inherently very greedy. So you're going to sell the 150 strike on Facebook. You're going to collect a decent amount of premium. You're then going to buy the 140 or the 145 strike. But when you buy that strike, it's going to eat into the net amount of premium that you receive, right? Because you're buying insurance. As a result, what humans tend to do, not everyone, but as a general rule, if they should only sell 2 or 3 contracts of verticals, they think, well, I have to buy this insurance, this put of Facebook at 145. As a result, this trade isn't making me as much money as I want. So instead, even though I know I should sell 3, I'm going to sell 10. And 9 out of 10 times, that's fine. But then you have a week like last week where Facebook drops at one point, it fell 20%. Like at one time, it was at 184, and then it dropped below 150. And Facebook's like a $600 billion company. Was it an overreaction? Yeah, of course it was. But does it matter when you have a margin call and the broker calls you up and then tells you that they're going to have to close you out of that position because you don't have enough money in your account? And maybe that happens 1 out of 10 times. The problem with that is the one time that it happens, you lose all your profits for a year. So that's the problem. If you are going to do verticals, which is completely okay, you have to be okay with accepting less money and also managing your position size.
What do you mean position size? Like what?
Right, because when you do a vertical, so if I sell, if Facebook's at 160 and I sell a naked put on Facebook with a strike price of 150, then I have theoretically $150 worth of risk, right? Because in the worst case
Right.
scenario, if Facebook goes down to zero and I'm short the 150 put, I'm going to have to buy Facebook at 150, right? Now,
100 share. Yeah.
now some brokers, they don't calculate it like that. Some of them look at like standard deviations or like 20% declines or things like that. It really depends on like what broker, whether you're using like Reg T or portfolio margin, but who cares? Forget about that shit. That's too complicated. It's not really pertinent. The point is that if you use a vertical, you turn $150 worth of risk in the worst case, if like theoretically Facebook goes down to zero, into $5 worth of risk if you buy the 145 strike, right?
Right.
So as a result, your buying power is substantially improved, or it's the decrease in buying power when you open up new positions. The decrease in buying power is mitigated substantially when you sell verticals versus when you sell a naked put. Because when you sell a naked put of Facebook at 150, you have $150 worth of risk. When you sell a vertical where you're selling the 150 and you're buying the 145, you have $5 worth of risk.
Okay.
Because if Facebook goes down to zero, then you're going to be forced to buy it at 150, but then you can also sell it at 145. So technically you have $5 per share or $500 per contract because each contract is 100 shares. But the problem with that is you're paying for that insurance. So the amount of money, the way that we make money is by collecting premium. So the amount of money that you're going to receive because you're buying that insurance is a lot less. And as a result, instead of doing 3 contracts, which is what you should do if, like, I'm just making up a number, 3 contracts, if you're trading naked, people are going to do 10 contracts. And when you have a situation where Facebook is trading at like 170, 175, and then it falls down to like 150, you're going to get a margin call, and those contracts that you sold are going to be like trading at about 5 or 6 times what they were when you sold them. And because you're in a margin call and you're trading too many contracts, you're trading 3 or 4 times as many contracts, because it is still a high probability trade, but you're trying to receive as much money as possible to compensate for the put options that you bought, you're going to end up losing all that money when the trade goes against you.
Right.
Does that make sense?
Yeah, it does. I mean, I guess people do get greedy because to me it sounds like these, I'm saying like Facebook, you know, being such a big company, it sounds like it's pretty consistent of how things are kind of moving. I mean, I remember listening to one tape, you were saying it's 2 moves forward, 1 step back, and that sounds pretty consistent to where things are, and I guess people kind of take advantage of that or try to, and like you said, get greedy.
But then what happened? Like, that didn't happen over the past 2 weeks when Facebook fell from like 185 to 150. So you have to be prepared for that, because maybe that only happens once every 2 years. But still, that happens. If it happens once every 2 years and you have too many positions on, you can lose. You could, depending upon how large you trade, you can lose 2 years of profits in 1 week if you trade too big.
Yeah. So, I mean, it's basically just try to stay cautious and just kind of work your way up and don't get too greedy.
You just have to watch your size. That's by far the most important. If you can control the greed aspect and you can control the entry point, meaning the selection on your strikes of where you enter the positions, you will easily make money by trading options. You'll make money 95 out of 100 times.
Yeah, I feel like you've been doing this for quite a while, so you kind of know how companies kind of, you know, these bigger companies you're dealing with, how they kind of are, how they, you know, certain months are kind of fluctuating this way, or when certain news comes out, you kind of feel like you know where it's going to go. I mean, you seem like you've been in the game a little bit. It's something that honestly, that's for experience.
I've been doing this for a really long time, but there's I can't tell the future. I had no idea that
Yeah.
Facebook was going to drop from 180 to 150. I had zero idea. The experience that I have, the only thing it's good for is like it allows me psychologically to not panic if something goes against me because I've seen it before. But it doesn't help
Yeah.
me. It doesn't help me at all as far as like
No.
predicting things. Like I don't use like bullshit technical analysis. Like I don't use any of that stuff. I don't look at like charts and cup and pattern handles and Bollinger Bands and like
I
all that
mean,
shit.
yeah, I don't believe in that either. But I mean, just simply looking at a chart and seeing that it's going up. I mean, almost anybody could look at a chart and say, "Oh, that looks like it's going up," or "Oh, that looks like it's going down."
Well,
Like,
yeah,
I mean,
but that's the thing though, right? So I always deal with market leaders. So all the market leaders should be going up. I do though, like look at a chart. So that was a little bit untrue what I said about not looking at a chart. What I want to do is like if I look at a chart, I want to see like over the past 3 or 6 months what its low is, and then
right,
I'll sell a put below that level. So for example, up until 2 weeks ago, if I had looked at a chart at Facebook, I would have seen that Facebook pretty much did not penetrate the 170 level for a good 6 months. So I would have thought that when Facebook was trading at 185, that selling a 165 put in Facebook because it's a market leader and because in the past 6 months it hasn't even fallen below 170 and it's currently trading at 185, I would have thought that that's an incredibly high probability trade. And it is,
right,
98 out of 100 times, 98% of the time. But you don't win 100% of the time, and then, it dropped down to like around 150. So yeah, I do look at the charts in making a decision of where I should sell the put. But,
right.
I mean, that takes me like a second, and that's something that anyone can do. Like
Right.
you can do
Yeah,
that
actually,
just by looking at it.
yeah, I've been trying to follow Facebook a little bit more because I noticed that's like one of your bread and butters there a little bit. You seem to like Facebook quite a bit, and yeah, I've noticed even a little bit in the news. I don't watch the news like you said too much, but they said they had like security issues or something like that, and I think that's what made everybody upset on Facebook. So I don't
Yeah, I
know if
mean,
that's the reason why it dropped.
Facebook's not going anywhere. What other social networks are people going to gravitate
Didn't
towards?
they?
They haven't even
Didn't they
started
come
to
out with
monetize
something else?
WhatsApp.
No, I agree. Your market leaders, it just seems consistent. It seems like you got yourself a pattern and it works. And it's just like you said, don't get too greedy there. Don't make your size too big, and be modest and keep it simple and
The other thing
try to
is,
go that route.
the other thing, and one of the major reasons why it's advantageous, and I've told other students this before, a major reason why you should always focus on market leaders is that you don't have to read anything. There's no informational advantage. For some reason in our society, people have such large egos that they have an incredible desire to be right. Like they'll defend themselves until their last breath, even though
Yeah.
everything, all the information out there is telling them that they're wrong, but they just can't admit that they're wrong and they want to be right. There's no need to, like, you can read as much shit as you want on the internet. That's not going to make you money. That's not monetizable information. And when you deal with market leaders, like a Facebook or an Amazon, there is nothing that you're going to read that's going to make you any money. Why? Because it's a $500 billion company. There are like hundreds of thousands of shareholders. All the information out there is public. Like you're not going to know more than like the investment banks who have a 5% position in it.
I guess like the one thing I was asking you, like saying like, hey, I'm an electrician. When I hear a problem, first thing I do, I run down my checklist. I guess just trying to pick your brain as much as I can. Is there like certain step rules? I mean, besides, hey, watch your size limit. If you're going to trade verticals, accept the less premium. Just like things I guess you basically don't even basically think about anymore. It's almost second nature probably to you, to where it would be beneficial to hear from you to me. besides, like I said, the size thing, that's greed is a part of everybody. Everybody's got a little bit of greed in them. Everybody's in it for the money. Just something that, I don't know, just an insight on something to where, like you said, it doesn't seem like too much work that you're doing. It seems like you're with market leaders. You don't have to do any kind of looking into. It's already there. Just kind of figuring out where to put your put and the strike price.
Well, let me ask you, do you have you put together a watch list yet?
I did. Actually, last one, man, looks like a good big company that's, like around my way. It always seems like the big people love Olive Garden and stuff. I was looking for Olive Garden and,
no, you definitely,
but I do.
You definitely don't want to trade Olive Garden. I mean, the restaurant industry is falling. I doubt that they probably don't even have options on Olive Garden. That's not a market leader.
Yeah, they did. But I'll read you some I got. I did put on Starbucks.
Starbucks
Walmart,
is okay, yeah. What else?
Walmart.
Walmart's getting crushed by Amazon. I wouldn't touch that. What else?
Home Depot.
Okay, it's not bad.
I go there every day. Disney.
Yeah, okay, Disney's a market leader. It's fine.
I was going to say, my brother was in the college program. He was in Disney. I did take a couple from you here. So Lockheed Martin, Facebook, Amazon, Apple, the GS, what's that, Goldstein or something? Or
Goldman Sachs.
Goldman. Netflix.
Yeah, Netflix is okay. I do think, I don't have a subscription to it. The people who do, my friends who have Netflix are fiercely loyal to it. I probably wouldn't trade it because I think it's overvalued, and I think as a general rule, especially in a market that has been extremely volatile over the past 2 months, and volatility is still stuck at 20, is still around 20, and especially for someone like yourself who's trying to learn this and you don't have a big account, you really shouldn't trade any more than like 2 securities. You need to keep it as simple and as boring as possible and just hit singles and take profits and win 95, 98% of your trades. And really the only way that you're going to do that would be to trade something like a Facebook back and forth. Let me see, Amazon might be a little bit tough because it's just so expensive. It's going to eat up a ton of your buying power. But you could do verticals in Amazon. That would be fine. But personally, in your situation with like an account size of 3,000, if I were you, do not overcomplicate things. I would put on Facebook, Amazon, and like Lockheed Martin, and I wouldn't touch anything else. Even Disney, I definitely wouldn't. Even like Disney or, McDonald's. McDonald's has fallen a lot. I still think McDonald's is below 160, and before it was at like 178. I wouldn't even touch that. Why take chances with your money? You have to treat your money like it's gold. And when you have a small account, don't take any chances. Just keep it as simple as possible. You should not trade. Okay. You shouldn't make any trades outside of Facebook, Lockheed Martin, and Amazon.
Okay.
Because those are the safest bets.
Yeah. Yeah.
Or if you like completely disagree with me, and you are fiercely loyal to Home Depot because you go there every day, and all your buddies who you've spoken to are like, "Yo, I would never buy anything on Amazon that I can buy at Home Depot because I love going there." Okay, fine. Like, I can be wrong. Like, you can disagree with me. All I'm saying is the major overriding point is keep it as simple as possible and do not, I personally wouldn't recommend that you trade more than 2 securities. So whatever they are, pick 2. Okay. And in my suggestion, my recommendation would be something like a Facebook, Amazon, and like a Lockheed Martin. So 2 of those 3.
Okay. Now that just a quick side thing. That GS, what was that? You said it was
Goldman. Yeah, Goldman Sachs.
Goldman Sachs. Yeah, that was when I first started paper trading. That was the first thing I did. I did a naked put at like, it was like 235, 236. I wrote it down. And then, I wanted to, I don't know what it's called when you make a put. And then, I made one above it. I guess I made a call.
Oh, you sold a call too? So strangle.
Yeah, strangle.
You did a strangle.
I figured, let's go wild first try. You know, I just want to sell my royal oats, I guess, on paper trading for a second there. Okay. No, I agree totally. I have no ties, no love for Home Depot or Blows or Lowe's, whatever they call it. It's just, you know, I'm in construction. I mean, I'm there a lot. So,
well, hey, look, if you're in construction, picking a company instead, if you tell me that instead of doing Lockheed Martin, you want to do Caterpillar, I'm fine with that too. I do think that Caterpillar is a market leader. It has a market cap of like $100 billion. There's a lot of liquidity. There are weekly options. And infrastructure over the next few years is going to boom. I personally prefer Lockheed Martin because I think that the defense and the technology budget is going to exponentially continue to increase. So I would definitely trade Lockheed Martin over Caterpillar. But if you have a strong affinity to like Caterpillar, then do that. That's fine.
Okay. Yeah, no, you're right about that. I mean, just the way things are going in the world, we're going to need all that defense and stuff. Kids are getting shot, everything. And but you're right, infrastructure, things are going to get built, you know. Okay. No, I like all this stuff. The one thing I looked into, I guess, on my own was just to figure out, like, if I was going to sell these verticals, and again, just using, for instance, saying Facebook's 160, I sell the put at I'd say 150, and then I buy the put at 145. It makes that $5 spread, and then whatever, I guess, the bid ask, whatever the mid is for both of those, you subtract, and then you subtract it from the $5, and then times it by 100 for every contract you buy.
Well, what do you mean? Why does the $5 come into play?
I guess, like I said, I was doing my own research on that. So when you do the vertical spread, it was trying to show you your max loss.
Oh, your max loss? Yeah, whatever. Fuck that. Don't even look at that. I know that sounds crazy, but I mean, look, you're going to win 95, 98% of your trades. Your biggest,
right.
The thing that you should always keep in the back of your mind is watch your size, because that max loss isn't even going to come into play, because in the worst case scenario, you're just going to roll out of that position. You're not going to take that loss. That max loss is if the position expires below, below the put that you bought, and if you let it. But even in the worst case scenario, if Facebook dropped down in your example to 140, you would just roll out of that position for a credit, and you would extend it and roll it forward in time. So forget that max loss. It's not. Okay. It's just there theoretically. But your biggest concern should be watch your size, because if in the worst case scenario Facebook drops down to 140, you want to have the flexibility where you can easily roll that position. You don't want to be in a margin call if Facebook drops to 140, the 5 out of 100 times that it will, and you want to have the flexibility without being hamstrung by your broker calling you that you have to meet that call or they're going to close out that position for a massive loss. But I'll give you an example. Wednesday, you know how many people got fucked on Facebook when it was trading around 150, only to see it the next day close above 160? How do you think those people felt? And the only reason they were forced to close out that position when on Wednesday Facebook hit around 150 is because they got greedy and traded too big.
Well, like you said, if they were too greedy, they didn't have enough to, I guess, roll out of it. That'll probably lead to my next question as far as, I guess, maintaining the actual trade, like how to roll out of a position. And I kind of get, like you said, you want to leave, I don't know, say there's 10 days left and it's getting kind of close. It's kind of testing me a little bit and I want to roll out of it. How would I do that? I mean, like I use the same thing you're using, Option House. And I mean, is it as simple as calling my broker and saying, hey, I want to roll out of this position for a credit? Or is it something to where I got to make sure first I have enough buying power, because if I go too greedy, I'm not going to have any money to roll out of it, I guess, and then I'm kind of fucked.
Right. Yeah, you wouldn't call your, I mean, you could call your broker and ask them what to do, but you want to avoid that because then they're going to charge you like $25 or $30 for making that trade. I place every single trade on my phone. I have never placed a trade. I don't think I placed a trade using the computer in like 5 or 6 years. Every single trade I make is on my phone. So, all right, let's say in your situation, first off, to go back to the example, Facebook right now, even though I know it was trading above 160 on Thursday, it actually closed at around 159 and like 76 cents, if I recall, something around that. So it closed a little bit below 160 on Thursday because Friday the market was closed because of Good Friday. So to go back and recap, those people on Wednesday when Facebook was trading at slightly below 150, for a lot of them, they were forced to close out the position because they traded too big. Now, running you back through that example, let's say, because remember, when you're going through the situation, you have no idea what's going to happen. Facebook could have fell to 140 as opposed to going up the next day to 160. So let's say you're short 155 puts, and it's Wednesday, and you just saw that Facebook close below or intraday traded below 150, and you're concerned. Now, you have buying power because you were responsible and you weren't greedy and you didn't trade too big. But your position expires, let's say, the following day. Now, usually options expire on Friday, but because it was Good Friday, the position is going to expire the final trading day of the week, which would be Thursday. So you're concerned. You don't want to get assigned. So what you would do is you would reverse that position. So that put that you're short, the 155, you would buy that back. All right? Then the put that you bought for insurance, that one, let's say it was a 150 or 145 put, remember, because you're going to be doing verticals, you would sell that. You would sell that. All right? Now, if you were just to close out that position, you would take a massive loss, and the reason is that Facebook has fallen 20% in 1 week in that position. So even though you made money on the options that you bought, the losses from the option that you sold are going to be much larger. So if you were just to close out that position, you would show a very large loss. But what you could do is you can buy that back, which would zero out that position, right? So you would buy back the 155, and then you would sell the 150, and then you would go out like 2 or 3 weeks, and then you would sell a lower price strike, like a 150 strike on Facebook, and then you would buy the 145. And the amount of money that you would receive for putting on that trade and rolling out in time should equal out or cancel out the money that you would lose to buy back the position, the original position. Do you understand?
Yeah, I guess that's going to take some learning there.
All right, so pretty much
as in the trade.
All right, so here, let's say I was short naked puts on Facebook with a strike price of 155, right?
Mm-hmm. Right.
And it was expiring like yesterday, all right, or Friday or Thursday. Like Friday. Let's just say Friday because forget that Friday was a holiday, that it was Good Friday. So what you would do is you would buy back that position, and then you would go out 2 or 3 weeks, and then you would sell and open up a new position with a lower strike price of 150, and you would collect money. Right? So let's say
let me stop you for a second there. So like you said, I want to buy back my 155 share.
Right. Yeah, you want to buy that back, and the reason is that expires the next day. And it's expiring with a strike price of 155, and you're scared shitless because Facebook just traded below 150, and you're $5 in the money, and you don't want to get assigned.
Right, but that's what I mean. I would literally go under my trade that's already there and then set a buyback for for today or tomorrow, or set it for what?
No, you're not setting it for anything. You're buying it back at someone's going to sell you, someone's going to quote you a price to buy back that position.
Okay.
Right? Because that contract that you sold now can be bought back. You're going to buy that back and you're going to pay a lot more money for it. But money solves problems. So that that position is problematic. It's a problem for you. You sold that position. Mm-hmm. And 5 out of 100 times, it's not going to work out. So you sold that position for $1. Now you're going to have to buy back that position for $8. So you're going to lose $7 for every contract or every share. $700 for every contract. $7 a share.
So I buy that.
Right. So
I buy that back. So I put out $700. I buy it back.
Well, technically, you would put out $800 if the price of that option was trading at $8, then you would pay $800 because that dollar that you collected, it's gone. Like it's like premium for a car, right? You pay the insurance salesman, and then then they just keep your money. Like they don't, you know what I mean? Like you sell something and then you pocket that money. It's gone. It's like it didn't even exist, right? So you collect that money. The amount of money that you receive for it is just bookkeeping purposes. So let's say you can tell yourself, okay, well, I lost $7 a share on this on a net basis, but the point is that it's going to be quoted at $8. So you're going to pay $8 a share for that to cancel that out. You buy that back, that frees you of the obligation to buy Facebook at $155.
Okay.
All right, so you're fine. You're not going to get a sign, but you don't want to lose money on the trade, especially when we make money 95 out of 100 times. So what you do is you go out 2 or 3 weeks because volatility is very high, and that means that there's a lot of fear in the marketplace. And when there's a lot of fear, then the amount of money that you can receive for selling options is extremely high. So what you do is you go out 2 or 3 weeks and you sell the 150 strike. So you're able to recoup and sell and be on the hook for a contract that's $5 below what you just bought back. And because you're giving, because you're agreeing to ensure that Facebook is not going to drop below 150 2 or 3 weeks from now, as opposed to just insuring it until the next day, right? You can collect, let's say, $10 for that. So even though you paid $8, you're going to be able to collect $10, even though you're also picking up the contract for $5 less than the original contract. You understand? So you're going to close it out and pay $8. Then you're going to sell for 3 weeks later the 150 strike, and you'll be able to collect 10. I'm just making up a number. So on a net basis, you're going to collect $2 a share for that, and you're going to relieve yourself of the responsibility of having to purchase Facebook tomorrow at 155 if it closes below that.
Okay. So, I mean, even just say worst case scenario, say you did all that. Say you had the 155 and you wanted to not close it out, but buy it back. And then, like you said, sell it 2-3 weeks out later at the 150 strike. Now, worst case scenario, say Facebook just drops even again 2-3 weeks later and it drops. You just keep rolling out of that position. You keep buying it back and then selling at a lower strike.
You just have to keep rolling it. I mean, look, Facebook's a $500 or $600 billion company.
Yeah,
it's not going to fall 20% every single week.
Leader.
Yeah, I mean, especially when it's a market leader, it's gone up tremendously over the past 5 years. Can we tell the future? No. Like, I'm sure that some people, if they listen to this call, they're going to be like, yeah, well, Facebook can drop 50% in a week. Yeah, of course, but what are the fucking odds? Like, if you're going to think negative like that all the time, then what's the point of even walking outside? I can get hit by a car and die. Like, what's the point of doing anything? Like, I can always point to that one person who did everything right and just had bad luck. I mean, that's what happens when there's 7.5 billion people in the world. Like, that shit happens. Yeah, like no one expected Facebook to drop 20% in a week either, but I didn't have to close out any of my positions. Did I roll my positions? Hell yeah, I did. I rolled all of them. And was I concerned? No, because even if Facebook dropped to 135, I just would have rolled it out. I just would have pushed it out more time.
See, I guess the thing for me is I haven't made any trades yet, so I don't know. I just want to get my feet wet and then see what I can do from there. Like I said, I place this trade, I sell the short, and then like I want to know what I'm able to do while that short is, I guess, collecting time, or what do they call it?
You do nothing.
Theta decay? Or?
Theta decay. 95 out of 100 times you do nothing. Your biggest decision is to control the number of contracts that you put on, the price that you enter, because remember, the only way that we make money is by collecting premium. So if you sell a contract for $1 and you could have gotten $1.50 for that, you fucked up because you just cost yourself 50% of the amount of premium that you could have received potentially. So that's not a good trade. You shouldn't sell something for $1 that an hour later is trading at $1.50, because the only way we get paid is by collecting premium. We are insurance salesmen. No good insurance salesman is going to sell you a policy for a 50% discount. They would get fired. You need to optimize the amount of premium that you receive. So there's a few things that three big things when entering a trade, right? You have your watch list. So to summarize everything, you have your watch list. Maybe you'll have 6 securities on your watch list, but you're only going to trade 2 or 3 of them at one time. I would say maximum of 2. All right. You're going to make a decision. What's my strike price? How many contracts am I going to sell? And is the amount of premium that I'm receiving good enough to compensate me for the risk of entering this trade? That's it. Super simple. And you just ask yourself that question 1,000 times a year and you make 50%. That's it. Yeah. Wash, rinse, and repeat. What's my strike price? How many contracts? And is the amount of premium that I'm receiving enough to compensate me for the risk that I'm taking? That's it. Now, in the example that you keep making, I personally would not trade Facebook 150 puts right now if I was opening a new position. Why? Why would you do that? Facebook on Wednesday dropped below 150. I wouldn't even touch. The lowest, or rather the highest strike that I would touch would be 145. Highest strike. Mm-hmm. And depending upon the amount of premium that I could receive, I would even potentially do the 140s as the highest. If there wasn't a huge differential between the premium received from the 145 to the 140, I would do the 140s. It's safer. Why take the risk?
See, let me ask you. It seems like you make your trades. I mean, you have a larger account, and I'm just surmising from you having a larger account that you play it safe to where you're pretty far out of the strike price, and but you sizably up your contracts. But like you said, you can, because you could take that risk because you were able to compound, I guess, over the years and do it that way. But I mean, is that how you make the bulk of your money, is by the size that you're trading because you're okay with that size because of the bank? Or is it just simply
I don't think I trade that many contracts. I mean, I'll have
What's not too many contracts for you?
Well, it depends on the underlying. So I'll do at any one time, I'll probably have around 200 contracts of Facebook on and 50 of Amazon. I mean, let me just see. So let's say I did 200. That's a good question. I've never done this before. So 200 times 100. That's 20,000 shares. Let's say the strike is 155. So that's about 3 million in Facebook. And then 50 50 contracts at Amazon at around 100, let's say 1,200. Yeah, I mean, that's actually a lot. The Amazon is huge, but it's way, way out of the money. I guess the best way I can break that down is to tell you that over the past 2 months when the market has fallen, when some of the stocks, like my biggest stocks, have fallen like 20%, I never had a margin call, but I rolled out the positions. But also remember, I have increased flexibility because even if I'm short, like 50 contracts at Amazon, but it's relatively near dated, meaning that let's say it's going to expire in 2 weeks. And let's say I'm short 50 contracts of Amazon. One thing that I usually always do is if I have to, I'll push that contract out 3 or 4 months, and then I'll reduce that size from 50 all the way down to like 25. So when I roll, I don't just roll for time and to reduce the strike price. I actually, when I roll, and I only roll like 5 out of 100 times when it necessitates it because almost all the trades are profitable. But if I'm forced to, like I have been the past 2 months, when I roll, I'll reduce the size too.
Okay.
I guess when you look at like the notional value, like even 50 contracts at Amazon at a strike of like 1,200, that's like $6 million. I mean, that's a lot, but I don't look at it like that. That's kind of like looking at your max loss. Like when Amazon's trading at 1,600, and I know it's not there right now, if I'm short 1,200 puts, I'm not really worried about that, especially because in the worst case scenario, I can take those 50 puts and easily cut it in half down to 25 if I just push out that position 3 or 4 months.
Okay. And the longer you go out, the longer you push it out, the more premium, right? The more.
Correct. Right. The more money you'll make. Because the same thing is if we're selling car insurance, if you buy a policy for your car and you buy a 1 year, it's going to cost you less than if you buy a 2-year contract or 2-year policy.
And like I said, I guess the only thing that's just tripping me up is just the fact that I made a trade, and like I said, I haven't exercised any of those rollouts, I haven't experienced any of that. So, I wish I could say, oh, yeah, we'll roll that out till 3 months instead of 1 month and then reduce your size. Now it makes sense.
Now is a good chance, an opportunity to do that, because in 2017, there were virtually 0 opportunities to roll out, and like every trade that you put on would be a winner. You would be bored. So now is a good time to learn, because no one knows what the market's going to do. So it can stabilize this week, or it can continue to go down. And you need that toolkit in your toolbox, the ability to roll, because that's going to allow you to manage the positions. And you might only use that a few times a year, but that's your parachute. That's your safety valve.
Right. I know we're probably out of time, or almost out of time. I know you said like an hour.
Yep.
But I think you've answered a lot of stuff. Like I said, it's something to where I just know I need to just get into it. Like you said, watch my size, look at my entry point, strike price, check my watch list, and, just see how much premium I'm going to make and if it's worth the risk of
You have
making that.
You have a practice account with Thinkorswim?
I do, but like I said, I'd rather just hop in and then
that's fine.
Learn that way.
How big is your account again? 3,000?
Yeah, 3,000.
All right. The only thing I'll say is just make sure that you're very careful, because volatility is still high. Who knows what's going to happen? The market can fall another 10%, or it could stabilize. Nobody knows.
Right.
Just do not get greedy, especially with a smaller account. You're going to be trading verticals. I mean, try to make your main goal right now should be to learn the skill and get comfortable and bank some winners. Don't mess around with any stocks that you shouldn't. Just deal with like Facebook, Amazon, Lockheed Martin. That's it. I wouldn't touch anything else. Maybe Caterpillar if you like it, but I wouldn't even touch that. Just Facebook, Amazon, Lockheed.
Okay. that keeps you in the loop with everybody as far as the $100 keeps you in the loop for
Yeah.
text. I guess you're using the WhatsApp or.
Yeah, exactly. 100 a week.
Oh, every week.
Yeah.
Okay. All right. Yeah. Now, like I said, I want to keep going. So, yeah, let's do another week, and then, like I said, I probably will keep going for probably a couple months, and then hopefully I can kind of take the training wheels off and kind of see if I can ride that bike. So.
Yeah, like I said, it's all wash, rinse, and repeat. It's those three things that I mentioned to you. So,
Yeah.
you know, once you get comfortable, there's no need to watch 5,000 videos and analyze the volume patterns and things like that. It's pretty, I don't want to say it's, the biggest thing I would honestly say is just making sure that you control your greed so that you're not trading too big, that you choose good underlyings, don't take too much risk, and then in the event that you have a situation where a position goes against you, like it did like this past week with like Facebook, or like 2 or 3 weeks ago with like Boeing, when Boeing fell from I think like 360 all the way down to like 320. A lot of it is psychological, but as long as you're able to hold your positions like a rubber band, and that rubber band doesn't break, then once volatility comes in like it did just on Thursday, I mean, you make all that money back.
Gotcha. How come everybody isn't doing this? That's it. Kind of seems basic. It kind of seems.
Well, the reason is
easy, but
there's just so much, because you have like CNBC, all those people have to validate their job. So everyone acts like they're super smart, like they have an informational advantage. They all act like they have like this superior knowledge. They're playing on the ego, and they're looking for low-hanging fruit for people who want to try to turn 10,000 into millions, even though they never did it themselves. Like even the people on CNBC who give you financial advice, how do you know that they're successful? Just because they leverage the equity of the platform that they're using to give you advice, that you don't know. They could be fucking alcoholic. You don't know shit about them, but people look up to them. Yeah, like there's just so much competing information out there that you don't know what to believe. You don't know who to believe. You just get distracted.
Yeah. This seems, doable. Like I said, I work a lot, and it's something to where my work is time consuming at times. You know, people's power goes out. I got to go. You know, I'm not saying I'm on call 24/7, but hey, if the money's there, I go out. But I work, 7 to 5, maybe later some days. So it just seems nice to where I can kind of just set it in motion and go. And as long as, like you said, I take that just a little bit of time and make sure I find my entry point, and just minimize my risk. So.
All right. Is it okay if I use this call for training for other people?
Absolutely.
Okay, fantastic. I'll send you a copy of this on WhatsApp,